Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Monday, January 23rd, 2023. It's 11:32 Eastern Time, so I'm starting the video, and what we're going to do in this one is stick to the broad markets. I'm going to cover all the major indexes, the S&P 500, the Nasdaq 100. I'll even hit on the Dow because I've been talking about that one lately, and then the Russell 2000. And time permitting, I'm going to rifle through the sectors in the S&P 500 and just some of those market-leading stocks, especially the big tech stocks. I think there's a lot here to cover right now. A lot of stuff going on. I'll follow up in with some additional posts later today, or yeah, I'll work on it today. Definitely get you something out on gold, silver, the dollar, any other commodities that stand out. But let's start out with the equity markets. We're on the site here because I just wanted to mention I got a post out to you. I finally had my programmer was able to fix those symbol tags, and I want to talk about those. I mentioned in there, if you're not familiar, you can see under every post, whether you open the post or not, you have the symbol tags. And so if you want to see, okay, well, let's see all recent analysis on silver, SLV. I click on SLV, it's the ETF. Usually you'll see together, the silver itself, silver futures, and SLV, and then you can get, as you see, in chronological order, or reverse chronological order, starting with the most recent, all the analysis there. So it's a good way to kind of catch up if you see a trade idea that's already been talked about, maybe active, go back there. You can also reference that, as I said, go to the resources tab here. This is my favorite area right here, tools of the trade, position size calculator. I can't emphasize that enough. When trading something like natural gas or Bitcoin, you need to take your position size down based on the volatility. Earnings calendar, economic calendar. This is a big one, throughout this bear market. Things like this didn't matter as much for the last 15 10 plus years. We were in a relentless bull market that was being fed with easy money and uber low rates, and so therefore market kind of just went up, and if there was a bad report, it would just shrug it off and buyers would step in. But now we're in a very much more dynamic macro environment, rapidly changing. The narrative right now, called this one perfect a few weeks back. Highlighted, it favored the big tech stocks, and that's what's absolutely been ripping lately. The charts were quite bullish, and so that's what's carried the market up and underweighted the S&P, and we see weakness in a lot of those. But the narrative, I think, right now is you're seeing everything that we talked about. The big tech. It wasn't only the bullish setups there that we had, the divergences and pullbacks to support on stocks like Amazon and many of the others. It was also the fact they were beat down, and even if they are, which I believe in the longer term, going lower, that's how bear markets work. You ratchet down, you get to, when you have stocks like Amazon down over 50%, you're going to get the dip buyers coming in, especially when there's any, it takes that collective mindset where they think it's safe to come back in the water. So anyway, where I'm going now, I think the narrative at this point in time is the market is very excited about this recent abatement inflation, and I talked about that a lot recently. This whole vicious cycle or negative feedback loop. You're going to see the abatement in inflationary forces, followed by a either implicit or explicit softening, or slightly more dovish or less hawkish expectations from the Fed. And again, implicit means that the market's assuming it, or it's implying that the Fed will slow down. Explicit is if the Fed starts to say they're going to slow down or stop cutting rates or anything like that. And again, it doesn't matter, implicit or explicit, is what the market reacts to and how it reacts. And so therefore you see that, and then you're going to see the fans of inflation start to roar back up. And so that's what it's going to be. I believe, and I've maintained throughout this bear market, that this one, I believe, it will be much different from all previous bear markets, really for about the last half century. So this one's going to be more similar to the one we saw back in the early 70s, or actually began in the late 60s. Every other bear market since then, you go back to the crash of Black Monday in 1987. The Dow fell over 20, what was it, 23% in a day, and there was that was not the whole extent of that bear market, but most of it, and it was over in a relative flash. It was, I think, a year, 18 months later, you're back to above where we were. You had the Asian contagion in 1998. The last two true bear markets, at least I consider, 2000 to 2002, the dot-com bubble, and that was, again, less than 2 years. And then the '07 to '09 market, and that was only about, again, a year and a half. And then COVID, of course. COVID was another a bear market that if you blinked you missed it. It was a 6-week bear market, 36% drop in the S&P 500, but it was over in 6 weeks. So my point being is that I believe a lot of the majority of market participants out there, both pros and retail traders alike, probably are trying to think this is going to be the same thing. All right, we're already well over a year into this one, and it's getting towards the end of it. And my take is we've most likely begun a new secular bear market that's going to have plenty of bull markets, cyclical bull and bear markets within there. Secular are your big trends, just like interest rates. Well, before I'll get to that chart in a second. Let me just get off this one here and show you that this is what I was referring to. If you want to find a symbol tag, you want to find something on, let's say, Treasury bonds, type in TLT. I didn't have to scroll all the way down. I just typed in TLT when I did the drop-down menu, and there's everything on Treasury bonds. All right, let's get into the charts now. And so, okay, so here's an example, TYX, and I've talked on this many, many times. I covered Treasury bonds for years. They are very significant. Interest rates are very significant to the stock market. They tend to work inversely. So we're coming off what will and has gone down in history as one of the most powerful bull markets in history. And again, I've mentioned some of the bear markets we had in there, but we were in a secular bull market. This is the S&P 500. This is what it looks like. Here's those cyclical bear markets right here, 58% or so when the 2007 to 2009, the meltdown in '08. Dot-com bubble took the Dow down over 50%. These are those other ones I talked to you about. 87, the Black Monday, total of a 36% drop in the S&P, so forth and so on. Even COVID, 35%. And so this is what I'm trying to explain. This is a secular bull market with cyclical bear markets and cyclical bulls, smaller bulls and smaller bears within the big trend. And it's not any bit of a mere coincidence that when you look at interest rates over that time period, TYX is a good way to look at it. That's the 30-year Treasury bond. You can also look at TNX. Interest rates peaked back here in the very early 80s. I think Carter leaving, Reagan coming in right there, the early 80s. We had runaway inflation. That's the last time we had comparable inflation back then in the 70s. And again, there was a bear market, prolonged bear market. Went from late 60s to the mid 70s back then, much longer than the current trends or the recent bear markets. And so this is your trend. This is your downtrend. I had a price channel. I've had these channels drawn forever and a day. And what happened in this secular bear trend in interest rates, you can see these. The channel was pierced. You see these pull downs here. And back in '08, when the financial crisis first hit, this is when the Fed started playing around with their zero interest rate policy, quantitative easing, and so that they had the power. They're probably the only single institution that has the power to have such a drastic impact. These are artificial pull downs in interest rates. These are natural market forces, the trend. And so by every metric that I have on here on Treasury bonds, we had a final, yes, Fed induced, Fed pulled the nuclear option, final selling climax, if you will, on yields, which is a buying climax in bonds. Remember, bond prices go opposite the yields. So we had a bottom there when COVID hit. The Fed was already super easy to begin with and had been since '08, and then just pulled out the all-out, hit the the nuclear button, and just went crazy. And so therefore, that really marked the bottom of. And by every chart, you look at a stock market chart in reverse when you see a blow-off top or a selling climax. That's what it looks like. And then the fact that you did from there went on to take out your previous reaction highs. Look how many we have so far, and most importantly, the primary downtrend. I had two lines, downtrend lines on my channel, right there, and this alternative downtrend line. Both have been taken out. So by just about every technical metric, this is early stage bull market action for what will likely be, in my opinion, a new secular bull market in interest rates, which is the same as a secular bear market in bonds. So bonds, the outlook remains, in my opinion, very poor in the long term, but they will be just like the stock market in individual stocks. They'll be great trading vehicles. There'll be plenty of bull runs and plenty of bear runs, but over time, I expect rates to not ever visit those lows again. And if that changes, it changes. But as of now, that's where we're at. So, and now we're again, the takeaway, a lot of you probably said, Randy, I don't want to hear about bonds. Bonds are boring. Bonds hardly move up and down. I want to trade stocks. I want Bitcoin. I want tech stocks. Well, remember, again, it was no coincidence that super secular bull market was coincided with this secular bear market in rates. Falling rates is beneficial to stocks, and it's simply because when rates are high, the higher rates go, there's that alternative. You have Granny that wants steady income, no risk, and is very happy with an 8% Treasury bond, ecstatic with a 10% Treasury bond or CD at her local bank. And then you have, of course, institutional investors as well, pension funds. The higher rates go, the more they can move money into safe, secure, fixed income assets to meet their liabilities, the needs of the pensioners that they have to pay out, and so money gets gradually. It's a incremental but pretty predictable move. The whole 60-40, whatever your split is, and it just plays out that way over time. The higher rates go, more and more people will opt to put gradually, usually it's a gradual thing, but move money out of equities into safe haven investments if they're going to be rewarded for it. Nobody wanted to buy a 0.2% CD a year ago, but now the banks are offering 3 and 4% CDs or whatever they're at. And when they go to 6-7%, you're going to see even more money coming out of stocks. So that's kind of the bigger picture. And I always talk on macro and then micro. We'll get to the micro in a second here. The point of this video is not to cover Treasury, so I'm not going to go into TLT or ZB right now. I just wanted to kind of reinforce the macro, the longer term big picture. All right, now let's get down to the shorter term and let's talk about where we are on the chart. So by nearly all metrics, we're still in a bear market in the stock market, and let's just talk again a little more micro or intermediate term by going to the daily charts. The shorter the term time frame on the charts, if I go down to a 60 or a 15 or even a 5-minute chart, that shortens the expectation of whatever I'm analyzing, whatever trade it is. If it's a 5-minute chart, that's a trade good for a day, maybe 2 days. If it's a daily chart, these are swing and trend trades that can last weeks to months. All right, so most importantly, today, biggest development, S&P 500 back to the primary downtrend line. That is a beautiful trend line. Beautiful because it has a lot of clean reactions, and again, just about anybody using technical analysis can see that trend line that the S&P 500 is there. Not only that, you also have the intersecting 200-day moving averages. Now, as I said, I can play glass half full, glass half empty, and that's what I do. That's my job. It's not to give wishy-washy analysis, tell you what I see. Now, normally, after you check in a bear market, especially when the bear market gets going and you come back up, especially a strong rally, to rally back to the primary trend line, and again those intersecting 200 days, that's it, and then you take the next leg down. So I have acknowledged, and that's well, that wasn't the reason for going long here recently, but I did acknowledge that when we did hold these lows and broke out as expected and rallied back up, that is a little bit atypical. Again, it's it doesn't mean that you can't get rejected here, but it does show that there's some strength. Some buyers stepped in, bought this dip, and they've already taken the markets back to that level. And so what happens is the more you test, tap on a resistance level, chances are, again, every security is different, but chances are you're going to break out sooner or later. And again, the fact that we're already back to that level and we hit it again, got rejected the other day, pulled back, and now we're back again. It shows there's a lot of buyers in here. So today's obviously a pretty good day, up 1.5%, 1.35% in the S&P. But again, we're at resistance, and as I say often, and it bears repeating, resistance is resistance until unless taken out. And this is a daily chart, so all I'm going to say is a SPY is, for all intents and purposes, right there now, hair above it. Needs to print a solid daily close, and it's not unusual. Once in a while, you'll get a close above there, or a close even for a week or so above the 200 days. All I can tell you is the further away you put these lines, the 200-day moving averages, which are down here, and the trend line, the further the S&P puts them in the rearview mirror, the more likely it is that that breakout's going to stick and not prove to be a whipsaw with a follow-through downside. So there we are. We're right there right now. And that's all I can tell you. SPY is on the daily chart at resistance. So let's look at QQQ. All right, QQQ, I had two trend lines. I recently took this one off last week, but I put it back. And this is, so I'm going to show you on a clean board. I know this is a busy board, meaning a lot of lines. I have this board right here. The same two trend lines. So this is my primary trend line, and this one has more reactions. It has, of course, these highs back here, late December highs, early January highs, right when the bear market really got going. That's when the S&P topped, and then you can see that both lines, it was rejected there. Here we popped just above the first one, and then hit that second, what I call BOD, or the uppermost. And that's still a magnet right there. I think that's where the NASDAQ will probably go. It hit it here, right there on this candle on December 13th, as I pointed out, but that was in the pre-market session, so it's not shown right there. But why it's it's almost a magnet. You can get this, when you get this close to a level, you can see you have the intersecting 200-day simple and exponential moving average, the red and blue lines. They're right there with the trend line. And so that is a very likely target if we go up a little more. And in fact, we're getting so close to it, we've taken out this trend line, increases the odds we may get there. But I will say the risk reward, I'll say the same thing I said last week. The RR is, despite the recent bid and giddiness in the market, wanting to gobble up these tech stocks, the risk reward is just awful. And in fact, it's very favorable to short right now, because a lot of eyes are going to see that we're up. This is one of the strongest periods of about 2 weeks that we've had in a while. We're overbought on the short-term indicators, and there you are again, 2%. Remember, the SPY is at resistance right now, at the comparable resistance, and the NASDAQ 100 is just 2% below. So what tends to happen is, you can hit it perfectly, but if a lot of eyes are looking at that level and a lot of traders looking to take profits, you could get rejected there. And again, we'll dig down a little deeper, look at some of the sectors where they're at now and some of the leading stocks, but I just wanted to point that out. We're just about 2% below that benefit of the doubt trend line. And we're still at, remember, this was back all the way from these lows back here. I gave you this red box, and I named it my most likely bounce target zone. We hit it there, got rejected, and then we hit the middle there, again, as a highlight in the pre-market session, and stopped. And it's still my most likely bounce target, most likely bounce target zone for this bear market rally, which this is part of, because we haven't taken out that low. So nothing changes, and you get there, and look at that, it's going to come in perfectly with that secondary trend line. Again, I know I have a lot of lines here, but you hit the 200 days and that trend line in the pre-market session back then to the button, gave us an excellent shorting op. And if you come up and hit it again, you're also hitting the bottom of the bounce target. Here, let me make the box wider. Let me just drag it out. That's it. Nothing's changed, and we can pop it. These indexes have a history. Sometimes they will go through the 200 days to blow out all the stops and then reverse, a week or so later, or a few days later, sometimes just a day later. Now, anything through there, and this was a max bounce target zone, so anything up above the red box, or the most likely bounce target zone, it's about 312, significantly increases the odds that the bear market ended here, and we're going to go up and probably have a more upside. But Very, very unlikely, in my opinion, that we're going to take out the previous bear market, bull market highs right here. So to me, it's more of a rally, matter. Do we go up there and have again what might be a little, considered technically speaking by the old metric a bull market, which is a rally of 20% or more. You'd have to go up to about right here. Actually, no. So yeah, at that point you would just be past. If you pop my most likely bounce target zone, and there's a big resistance level there, about 317 and change, then you're going to have, technically speaking, but again, that is an old, antiquated, metric in my opinion, because the Fed has supersized the big bull market we've had for the last 15 plus years, and therefore we're noticing, I've noticed the corrections have gotten larger, and that's why I said even COVID, to me, 36% drop, yeah, that will go down in history as a bear market, but to me it was just a correction, an ongoing bull market, and that's also evidenced by the fact that we maintained above the some of my key long-term metrics like the 20 period monthly average and the primary trend lines and all that. Here's the S&P. Back then we regained it. See, 1 month down through and snap right back above, and so that's where we're at. All right, let me give you the other indexes. So that's it. SPY at resistance on the daily chart, trend line and 200 days. QQQ within 2% below the that resistance level. Very likely reversal point if you're looking to game a pullback trade. The Dow, if only covered recently, is sort of a mini proxy to the S&P as well by looking at some of those holdings. And last week I showed you we had this uptrend line here, which so far they held and successfully defend. We hit it, tested it 2 days, and we're bouncing off it. That needs to go. If that goes, then well, and then just below it, you have the key 200 days. So the Dow is above the key 200-day moving averages. It got rejected here, and it broke above them here, and it back tested there. So the Dow, to really firm up another leg down the bear market, it's going to have to come out, take out the 200 days, and then give back this trend line, which it took out, and it's above right now. Again, I'll go over some of those stocks there in a second. Small caps looking probably better than any other index right now, in my opinion, because it took out its primary downtrend line right here recently, took it out, back tested, and still above. Now it's not very far above, and it has big resistance there at 190.40. If it fails that, then what I would do here, I'm going to do it right now. I'm going to add a little uptrend line off the lows and get a little triangle pattern going. So bottom line, bullish if the small caps take out 190.40. Bearish if they lose this downtrend line that they took out right here and move back above it, and then even more bearish if they take out that uptrend line. This uptrend line, it would help to have one more bounce off it, a check and a bounce to help validate it, to give it 3 distinct reactions. Right now it's just a potential trend line. Obviously, a break of the recent lows would be very bad, and that's what the small caps look like. There it is. So pretty much came down here at my 3rd target. This is still my 4th target in the bear market, and or that uptrend line that comes in, the longer term uptrend line. So just like the SPY, QQQ, I have longer term bear market targets that I have a high degree of confidence will be hit. To me, it's just a matter, are they going to pop these 200s and run for a little while, maybe come on all the way back to 209 and in the small caps? If so, it'll go down. The media will talk about it being a bull market, new bull market, but to me, it'll just be a counter trend rally within a larger bear market. Okay, quick sector analysis. Let's run through them quick so I can cover a few of the market leading stocks. XLK, the biggest sector by far, the most important. About half of the NASDAQ 100 is in tech, and it's also the largest index, or sector I should say, in the S&P 500 at about a quarter weighting. So without even a close second. Healthcare is number 2, and it's way down there. So XLK, you can see I updated my numbers at the end of the year, right after the new year. It's a 25.74% weighting in the S&P 500. There's your components of the index, of the XLK, the tech sector. So at resistance and the 200 days. So really what's happened here, and this is what I told you, made it clear a couple weeks when we were in this trading range, I favored tech. I thought tech would outperform the broad market, and that's evidence of it here, that the tech sector is already back to its 200 days right now and the downtrend line. I only have the single clean downtrend line on it, and while QQQ is still a little bit below. That's because those big fangs did outperform, and that was the place to be for the last few weeks and into today as well. So the rest of the market either needs to play a game of catch up, or I think we'll again start to see some profit taken in big tech soon. But I'll go over those in 1 second. All right, second largest sector in the S&P 500 is healthcare, and that's at a 15.82% weighting. Healthcare is back into the big old, looks like a massive topping pattern. It's a, at very least, it's a trading range. It's tried to break out 3 times now, and the previous 2 times after the breakout failed, we went back down to the bottom of the range, and this breakout failed, and that's what I think will happen as well. Move back down to the bottom. There is a little trend line here that if taken out could pop, maybe maybe we get a breakout above. At this point in time, we've had these 3 false breakouts, so what you want to do is put a line right above, above them, and pretty much if it breaks out again, number one, it would be atypical because you get these breakouts, like I said, and usually you go back down. Just like the stock market, the fact that we recently tested the 200s and the trend lines, and we're already, if you can get another run up here, I'm going to say that's bullish. It shows there's a lot of support, a lot of buyers stepping in at the top. However, that pattern says, once you enter, the likely next stop is the bottom of the range, and yeah, that's what I still see with the healthcare sector. And again, it's sector rotation. This is why, said tech would be the place to be. You go, and you can even still do this now. Go long the most bullish stocks, go short the most bearish, or at least avoid those sectors. XLF financials, a little minor trend line right here that broke recently, and we're still below it. So PPO looks poised to make a bearish crossover. This to me is one of the more less bullish sectors, let's call it, or I'll even say more bearish sectors in the S&P 500. XLY, this one's poised. It's a downtrend line resistance right now. XLY is a consumer discretionary sector, but it has, and it makes up, I should say, a 9.8% weighting in the S&P, but it's mostly Amazon. About a quarter of it, over 23% is Amazon, 10.5% Tesla, and then Home Depot and Nike. That's how that, and Nike's only a 4.85% weighting in that sector. But there it is. You have a downtrend line right here. Like a lot of things, especially tech-heavy sectors and the tech stocks, the big fangs, because of Amazon, of course, you have that big, strong positive divergence. And so the bullish case, it will need to take this out. If it takes out this trend line, here's your primary downtrend line right there, and the 200 days coming in. So just like the stock market, you have limited upside to the tune of, in this one, of about 5, depending if when it gets there, but yeah, about 5, right at about 5%. And there's price resistance as well, 147.74. I'll get to Amazon and those big stocks in a second. So XLI industrials, kind of going nowhere for the last, it had a bear market and it's back towards the highs. It's kind of in no man's land now between support and resistance. I don't have a big opinion on the industrials. XLC communication sector, this is about a 7.25% weighting in the S&P 500. Meta is one of the biggest, about 15%, with Alphabet being the biggest, about 23%, and then Verizon and T-Mobile at about 9.5% and 4.8%. Just kind of give you an idea what's in there. And recently we took out this, there was resistance right here. We popped that, and resistance just above it at 52.90. That was taken out today. So that's glass half full stuff, especially because it comes on the heel of a big divergent low, aka positive divergence, PPO making a bullish crossover. So those are, that's a check mark for the bullish case. That is, however, glass half empty, glass half full thing, we are in a bear market. I'll say it again, we're in a bear market. This one just ran into the 200-day simple moving average, the blue line with the 200 exponential just above it. Go back here. This is a weekly chart showing those same lines. You just go to a 40. You just plug in a 40 value on the weekly chart, because there's 5 days in a week. So 5 times 40 equals 200. It's the same thing as a 200-day. And you can see, as I can show you here, how in a bull market those lines act as support. In a bear market, when they're taken out, like they were in COVID, you were in a bear market. When they were recovered, you were in a bull market. And in a bull market, you trade above the 200s. And in a bear market, when they break, well, that says trend change or a sell signal. You back tested, and this is the first back test of the 200s since this one right here, shortly after we broke down right back in the end of 2021, early 2022. So that's worth noting. All right, so we have that's the takeaway, guys. Is the price action lately strong? It was expected to be strong a few weeks ago. I got out a hair early last week on some things. Actually, Amazon, which was my top holding, is right about where it was when I sold it. I'll get to that in 1 second. I'm just trying to show you that the upside, and continue to say what I said last week, the RR right now for new longs is not attractive. If you didn't buy, if you weren't buying a few weeks ago, do what you want, but I would be, again, selling today, taking profits on longs as an active trader and or scaling into shorts. XLP, back tested there. It hit support recently. Now, what happens is as I go down on these sectors, they don't move the needle as much. This is only 7.2% weighting, so I don't need to go over these in detail. Even energy, as strong as it's been, is only a 5.25% weighting in the S&P. Utilities 3.17, hit that $68 support, bounce there, but again, it's kind of going nowhere. These are duds right now, in my opinion. These sectors, and again, it doesn't matter how bullish or how bearish, because at a 2.74% weighting, it's not going to move the needle. It would have to go up 10 times more than the tech sector that day to equal the impact, the weighting, or to offset anything that the tech sector as the largest component at over 25% does. So that's it, or 9 times. Okay, last but not least, let's look at big tech. All right, we're going to start with the 60-minute chart. This is Apple. Apple, one of the 3 that I took as a hedge, when I was short here, and then told you I removed those, covered all the shorts and went long and kept those longs that were initially longs as hedges against shorts, and then wrote them out. Max bounce target was up here, that was hit, and then we carried over that a little bit, broke down from this wedge recently, and have had an unusually strong rally. And I think it's just, these are just latecomers that are now catching on to the fact that I don't know. Here's the headlines, as you probably read. Tech is just continues to lay people off. I mean, Alphabet just laid off, I think it was 12,000 people. And you read the reviews or the headlines on that. It was kind of arbitrary. They're not even telling you exactly how they did it. Some of these people had 7-figure salaries. So I can see the street is lauding that. They're applauding that, thinking, okay, well, tech's cutting the fat. Well, first of all, the charts were constructive and bullish. That was the reason for entering. Now the news. So all this, you got to ask yourself, how much of that run? By the way, Apple's the only tech company that has not laid off, and they're being quiet about whether or not they're going to do any. But most of that's been priced in. I think the technical on this rally, the technicals for that the rally. But so kind of where I was starting the beginning of the video, how the news and the macro ebbs and flows, and the market participants trying to get their hand on things. So they're applauding the fact that these are big layoffs in the tech sector. And so far, relatively speaking, there have been other sectors, but it's mostly contained to tech. And they're thinking then that's the good news. But when you start seeing these layoffs, sooner or later, especially if it continues and works its way into other sectors, you're going to see the headlines worry about, again, I've said this 100 times, consumer spending accounts for 2/3 of GDP, the majority of it. And you start seeing layoffs. So what the market's doing, their stocks are rallying because they're saying, okay, well, the Fed's biggest concern about inflation, we've already seen oil and gas and food prices come down, and we knew inflation was abating that way. Auto prices are finally softening. But the big thing the Fed's been worried about is wage labor inflation. And with layoffs and a softer job market, then that's less likely, right? But then sooner or later, this market's going to turn its focus towards the fact that we are seeing the job market finally roll over, and then that'll be the waves. That's what we're trading, the bigger waves. I'm talking the macro now, so we'll try to get ahead of that trend, um, and again, focus on the individual stocks and individual sectors with the most bullish and the most bearish charts. It is a stock pickers market, and it has been for over a year now. And so just wanted to follow up on this. So this was a QQQ right here, but that was the max upside. I had the maximum target or resistance I hit. It was also max bounce target back then. It was 285.60. We're a hair above that now. I already covered the daily chart. Told you we're 2%. Most important thing right here, 2% above the downtrend line in the 200-day moving average, 2% below that. But here's what I want to cover. Apple. Okay, Apple, remember we had, as highlighted at the time, a bullish falling wedge pattern right here, complete with the requisite positive divergence that I like to see, breakout, back test, and then that led to this trend up here. All along I've had alternative trend lines. I had my BOD, benefit of the doubt, and then this one here. So right now we're at that benefit of the doubt trend line. Right there, hair above it, but not even a solid close above it yet. So there's some resistance there, and when I look at the daily chart, more significant, I think, is this downtrend line right here. This downtrend line comes off that August peak right there, the mid-August highs, and you have that, of course, that initial reaction, and then several reactions, 1, 2, and now if we reverse here today, that would be 3. And there was that uptrend line that we broke last week, but it proved to be just a little whipsaw down through there, and this move here today. So either way, Apple at resistance. Should it take this out, I have a minor resistance. It's not very big, so I have it dimmed down. It's about 144.76. There's your 200 days, and pretty good resistance up around here. So that from today's highs, the 200 days start to come in about 2.5 to 3, almost 4% above current levels on Apple. Microsoft, let me go back to the 60-minute chart. Microsoft has just hit this 245.79 resistance level. I believe these are the same lines I've had on the chart for a while. It's pretty decent near-term resistance. Again, it's on the 60-minute chart. And here's an uptrend line to watch. So if that uptrend line breaks, that would be a sell signal on Microsoft. And look what you have. For the first time in a while on the 60-minute time frame, this high today and that rally into resistance gave us negative divergence. The last time we had negative divergence was right here back in December, and that was your divergent high. From there, the stock fell 16.5%. Alphabet broke out. I'll give it that. The market liked the fact that they slashed 12,000 jobs or whatever it was. Popped above the downtrend line. Can't say that's anything more than or anything less than bullish. But right into, I have this number here for a while, 99.72. Pretty nice resistance. Was resistance here. Last reaction high there. And if it takes that out, you do have a reaction high here, but my next level, it's a zone, it's up here, and that's even bigger resistance. More reactions from above and from below. So that would be about 106, a little shy of that. Like Microsoft, if you zoom in nice and tight, you could probably draw a near-term uptrend line to watch. And these are pretty steep uptrend lines, so if they crack, you probably see some quick selling. And then if you are looking to get into Alphabet, here's an uptrend line off the lows, so any pullback to that trend line there may provide you an objective entry. Again, also keep in mind, like I said, we're getting very stretched, very overbought on these shorter term time frames here, like the 60-minute charts. Not necessarily the daily or the weeklies, certainly not on the weeklies, but shorter term. Amazon. Okay, that was my top pick a few weeks back. Based on this constructive 60-minute chart as well as the daily chart and long-term weekly chart at long-term support. That was the target was right here, the downtrend line and this resistance zone 96.50 to 98, and we are still in that resistance zone. We hit it, pulled back, and we're right there again. So it really hasn't gone anywhere. I laid out when I gave you these potential targets, there's a potential to see more upside in all of these. And like I said, I'm on the fence whether we're going to get that or not. Amazon is still well below its 200-day moving averages. So I still, at this point in time, I'm not in it. I haven't re-entered yet, and I may not re-enter. I don't know. But I still think it's one of the better looking ones right now. But I don't buy it here at no man's. It's at resistance right now. If anything, it's a short, with a stop above the recent highs. But maybe just give this one a little time, see which way the market goes from here. Alphabet. This is GOOG. Let me go to the other share class. Did I already cover that one? Yes, I did. I already covered GOGL. So we already covered that one. NVIDIA, 60-minute chart, divergent high. See, a lot of these stocks are now putting in divergence here on the 60-minute chart, and they're also running into resistance. Although I will say, NVIDIA actually just took out a downtrend line here on the daily, so that's worth noting. I've shared a lot of tech stocks lately, and the majority of the setups I've shared have been on the long side, so you do have to recognize that, and a lot of those are breaking out. I mean, we had we had CRM. I did a follow-up post today. There was the news with some activists got involved in there, and beginning it was a constructive chart. But that one's been highlighted. Today was the 6th time I think since the 11th of January, and we had, remember, that breakout on Friday. We broke above the trend line and that's recent trading range by a little bit, and then followed through today. So there's that, and there's like I said, takeaway is individual stocks and/or sectors, or even, well, if you do the indexes, they tend to move together. But that's the way I think is a safe, especially if you're somewhat risk adverse and you have the time and the inclination or effort. And I'll try to help you do that. Sniff out and be long the most bullish stocks and/or sectors, and/or short the most bearish. And I think that's the way to go right now. That, of course, that's your equity portion, and that should never be all of one's pie. That pie is going to consist of different slices, and depending on how things look at the time, hopefully that have different slices, such as fixed income, i.e. bonds, and that could be corporate bonds, treasury bonds. It could be long or short. Commodities, and within commodities there's a whole different arena of spectrum of different things. Industrial metals, precious metals, grains, gas, oil, and at any point in time you can be long some of those things and short others. And it's the whole, don't put all your eggs in one basket. The more diversified you are, but you have to be diversified not just among individual stocks. Portfolio of, let's say, 10 stocks, if they're all big tech stocks, Amazon, Facebook, Microsoft, Amazon, or Meta, you're not diversified. You might have a dozen holdings, but they're all tech stocks, and they're all stocks, and they're going to ebb and flow with the stock market. So you want different sectors, and then you want different asset classes, bonds, commodities, and that's the way to smooth out the bumps, especially in a volatile, very rapidly changing news-induced market. This market just hangs on every little Fed statement, every little economic report, whether it's jobs report, CPI. These things have a big impact on the market, have for the last year, much more so than in recent years. And again, it'll grind you to pieces if you're putting all your money in natural gas or all your money into the NASDAQ 100. All right, I'm going to wrap it up here. And like I said, I will follow up with updates on gold, silver, the US dollar, and any commodities that stand out, or any updates to those that I recently highlighted. This has been Randy Finney with Right Side of the Chart. Have a great day.